Ben Friedman taught me many years ago, if you want to sell a book, you have to say its title 3 times. The Banker's New Clothes, available for sale in the lobby. Joking aside, I think they've given us an incredible food for thought. Obviously, the punchline of 20 to 30% capital as a judgment call is something that even those of us who have some appetite for strong statements may find a bit much to swallow. And that's worth discussing. So we have a terrific group, as I already said, to discuss it. I'd first like to call Morris Goldstein of the Institute to come. Just as a clarification, I'm going to ask each of the speakers to speak from the podium so you can focus on them, and then we'll all go up to the table together for the group discussion.
Good afternoon. It's a great pleasure to be part of this book launch, and I want to thank Adam and the Institute for inviting me. I won't hold you in suspense about my overall evaluation of this book. It is a stunning achievement. Indeed, I regard The Banker's New Clothes as the most important contribution to the analysis of banking regulation in the past 25 years. One has to go back to the late 1980s and to the work of Benson and Kaufman on structured intervention, bank resolution, and prompt corrective action, work that subsequently led to the overhaul of U.S. banking regulation in the 1991 fiduciary legislation to find a comparable tour de force. This book should be required reading for bank regulators, bankers, and legislatures. It should also do a lot to demystify banking for the concerned public. It is beautifully written and forcefully argued. Anat and Martin are not the first scholars to argue for much higher and simpler bank capital requirements, but they make the case for that reform more clearly, more comprehensively, and more persuasively than anybody else. In so doing, they also expose the claim that the banking industry has long been making about the dire economy-wide consequences of much higher equity requirements for banks for what it is, namely nonsense. Hopefully, The Banker's New Clothes will ultimately lead us both to a strengthened Basel International Agreement on Bank Capital and an enhanced Dodd-Frank law, the centerpiece of which ought to be a minimum unweighted leverage requirement for banks that is at least closer to 20 to 30% than 3%. Given time constraints, I want my remarks to emphasize 10 summary points from the book that merit a prominent place in the ongoing debate about bank capital standards. First, if you evaluate the proposed reform of much higher bank capital requirements on the right metrics, that is, on a comparison of social benefits and costs rather than private ones, and if you focus on the appropriate measure of capital, namely common equity as a share of unweighted total bank assets, then a benefit-cost calculus is not a close call. It rather points strongly to the desirability of requiring a much higher minimum leverage ratio. The minimum leverage ratio of 3% in Basel III is way too low. Likewise, the actual leverage ratios currently maintained by banks in the advanced economies are way too low. For example, the October 2012 Global Financial Stability Report of the Fund indicates an average leverage ratio for euro area banks of around 2%. Neither the empirical evidence nor economic theory supports the banking industry's claim that much higher equity requirements would have serious adverse effects on bank financing costs, on bank loan growth, or on economic growth. The time series evidence draws on 100 years or more of data in both the US and the UK, including long sub-periods in which ratios of bank equity to total bank assets were much higher, often by a factor of 5 or more, than they are today. In this time series data, there is no statistically significant link between higher equity on the one hand and higher spreads on bank lending relative to reference interest rates on the other. Similarly, there are no obvious links in the time series evidence between higher bank equity and either lower loan volumes or lower growth. Bank credit crunches typically come when banks have very low levels of equity, not healthy ones. The cross-section evidence is similarly unkind to the banking industry. Non-financial firms in the U.S. have average equity ratios closer to 50% than 5%, and yet these non-financial firms exhibit no difficulty making investments or maintaining adequate returns or raising new equity. As the authors point out, some of the most successful corporations in America like Apple, fund themselves exclusively with equity. It just doesn't make sense to conclude that relying so heavily on debt is a secret funding formula for success that only the banks know about. Empirical studies that point to large adverse macroeconomic effects of higher bank equity typically suffer from major methodological flaws. One such major misstep is failure to recognize that higher equity reduces the riskiness of both equity and debt and thereby lowers the required rate of return, blunting any sizable increase in overall financing costs. Treating the required rate of return on equity as independent of the mix of equity and debt, and failing to acknowledge that the return on equity can be manipulated by higher borrowing, have also led the banking industry astray in relying on return on equity as a preferred indicator of bank performance. Over a 2-year period, there are unlikely to be any important adverse macroeconomic costs of higher bank equity, particularly if higher equity is financed by retained earnings and a temporary suspension of dividend payments, and if higher regulatory minima for bank equity are mandated to come from the numerator rather than the denominator of the capital ratio. When you put all this together, you do not find that the increased taxpayer protection against bank distress and bank insolvency provided by much higher bank equity must be paid for or traded off against higher financing costs and slower growth of the macroeconomy. This alleged big trade-off is a myth, and since there is little downside to higher bank equity, we can and should ask for minimum leverage requirements that are much higher, in the 20 to 30% range, rather than, say, shooting for 4 to 7. Second, contrary to what you hear, banks that were distressed or required government assistance to avoid insolvency during the 2000 to 2007-2009 crisis had on average quite low levels of equity. Further, simple leverage ratios did a better job of predicting which banks would not get into trouble during the crisis than did more complicated measures based on risk-weighted assets. Third, the dilution argument against much higher equity is much overstated. As Anat Martin put it, with increased equity issuance, the shareholder gets a smaller piece of a bigger pie versus a larger piece of a smaller pie prior to dilution. There can be no assurance that the former combination will make the shareholder worse off than the latter. Fourth, banks are different from non-financial firms, but not in ways that repeal the basic tenets of finance. Yes, bank failures carry higher contagion failures than failures of non-financial firms, but excessive borrowing carries increased risk for banks just as it does for non-financial firms. Higher borrowing by banks relative to non-financial corporations is not easy to explain with reference to the intrinsic features of banking. It is better explained in terms of subsidies extended to the banking industry, and especially too big to fail banks, by the official safety net, by the large amount of lobbying that the banking industry does to deter tougher rulemaking, and by the conflicts between shareholders and creditors that occur when there is a large overhang. Fifth, on international competitiveness, the wider national interest is not served well in the longer term by lax regulation that promotes banking fragility. Ask yourself, are the US, UK, and EU banking systems now better off or more competitive because of the low capital ratios that were permitted to be maintained prior to the 2007-2009 crisis? Second, there should be no presumption that the existing size of the financial industry is necessarily the right one, especially in an environment where the banking industry is the recipient of very considerable subsidies from the official safety net. Seventh, there is little evidence from the global financial and economic crisis that either short-term debt or subordinated debt exerts effective discipline on bank managers. Eighth, common equity is likely to provide better loss absorption in a crisis than contingent convertible bonds, and without the thorny manipulation and threshold issues associated with those. Ninth, the existence of a large shadow banking system is not a good reason not to raise significantly bank equity standards. Instead, the appropriate policy is to require suitable capital standards for all institutions that offer banking services to the public, and to assure that all financial institutions, bank or non-bank, whose failure would have systemic consequences, have enough equity. Finally, if we were able to agree on and implement a much higher minimum leverage requirements for banks, we could simplify considerably the broader regulatory regime. With much more self-insurance, one would not need to be as concerned about activity restrictions. be they of the Volcker, Vickers, or Liikanen variety. Similarly, we would not need to reach a limit on the size limit for large banks. And with risk weights no longer relevant for calculating regulatory capital, we would not need to be concerned about banks gaming these weights with their internal models or about the regulatory implications of errors by credit rating agencies. But the inverse is also true. If we're not able to agree on much higher capital requirements, then lack of adequate self-insurance will require a host of other more complex initiatives to limit the prospective size of a failure or to place more of the financing burden on creditors. To sum up, this is a terrific book. It took courage, a deep understanding of banking and finance, and first-rate expository skills to write it. My congratulations go to the authors. I hope it is widely read and its message is taken to heart by those who can change the status quo in banking. Real reform is long overdue.
In that spirit, I call upon David Schraa. I'm going to give him a little bit more time than Morris had. I think he has a little bit more to work through.
Well, everybody else started off with thanks. I kind of think I don't feel like saying thanks. I feel a little bit like the pigeon thrown in amongst the cats, being the industry guy here. But we will proceed anyway. The book obviously is part of a huge discussion that's going on in the industry, regulators, academics, press, grappling with the outcome of the crisis and the really serious issues that the crisis exposed. Nobody knows the cause of the crisis. There is no one cause of the crisis. But I think one of the major causes of the crisis is that everybody basically made the wrong assumptions about the so-called Great Moderation. Everybody from Greenspan down underestimated the risks of the real estate market. Maturity transformation was carried to excess, somewhat more by some institutions than by others. There were a lot of serious risk management failings. There was poor underwriting of the underlying risks. There were problems with ratings, which are well known, but although they were largely confined to certain asset classes, but still very serious. There were wrong assumptions made about market liquidity. And actually, we also have to blame Peter Fisher because he did such a good job on solving the LTCM crisis that people probably underestimated the risks that the system actually was running. Obviously, there were serious regulatory failures. Failure to regulate the underlying mortgages was one of them. Basel had not yet gotten to the quality of capital issue, although it was on their list, et cetera, et cetera. Now, I think it's also fair to say that the industry and the regulators were starting to look at those issues in 2006-07. We published a report in March of 2007 on liquidity risk management that did not stem from any sense of great crisis or impending disaster or anything, but the sense that that liquidity risk management did need attention. I think that's just an example of the fact that things were not quite as bad as one can think, in the sense that there were people who were more alert to the risks than others. Now, in 2007, 2009, obviously there was a huge regime change. The firms that did not fail looked into the abyss and did not like what they saw. Same things for the regulators. All of a sudden, there was a radical transformation of banks' balance sheet. Banks looked like much more risky investments. Shareholders were wiped out or very, very seriously diluted at a number of firms. And there was a pricing explosion of debt and equity for banks at that time for good reasons. That had an inevitable effect on the availability and cost of lending, although because of the economic conditions, demand went down somewhat. And basically, we're still working through all the results of that period. We're not done by any means. So, what needs to be done to make the system safer? More capital is certainly part of it. We agree with the authors up to a point on that. Assuring more liquidity in the system. I think Basel is directionally going in the right direction on that, even if we might have a number of quibbles with the way they're doing it. The question is how far and how fast to go, especially on equity, and what is the right risk growth trade-off. I think contrary To the authors, we think the trade-offs are very real and are especially acute during the transition period that we're in now. On what terms will investors invest, either debt or equity? What is the credit-generating capacity of the banking system as it is? These are all very serious questions that need to be addressed and aren't addressed fully in anything that's available now. Now, the authors basically sort of reify the Modigliani-Miller theory and postulate a kind of easy and painless way out of a complex situation. That's fine. It's nice to hear that capital is cheap, so just raise capital and all will be well. That's actually probably okay as a sort of academic theory, and it may be okay in a very long run sense if you get to that sense. But the point of the problem now is, how do you get to the situation where we really build a global economy with global growth to the extent that we need? We can't assume our way to growth. The stakes are high, and other than sort of comforting assertions that it will all work fine, the authors haven't really answered that question of what are the risks, how do we get there. So we certainly don't have all the answers at the IIF either, but let me say a few things about where we're coming from. First of all, on the regulatory side, we have not, contrary to what they say, we have not been stonewalling change. We support many things that are being done on the regulatory side. We support the G20 program for consistent enhanced regulation in the global economy. And by the way, when we say level playing field, we do not mean national champions. We mean the opposite of national champions. We mean allowing competition by firms from all countries in all other countries on roughly the same regulatory basis without egregious differences. We believe very strongly in the basic Basel III capital and liquidity program. We also believe in the original timeline, which is a major difference. We have been advocating for several years now a strong resolution program so that firms can exit the market without disruption and without cost to the taxpayers. And assertions that banks are trying to continue government guarantees are just not founded in fact. We're trying to get out of the government guarantee trap, except for obviously deposit insurance and that sort of thing. We have supported improved impairment on a more expected loss basis since well before the crisis, at least since 2004. We've supported enhanced supervision since 2006. We've been saying that all along. We support effective colleges of supervisors. We support enhanced disclosure in the EDTF process that the FSB ran last year. We've been very active in improved risk management, risk governance, and risk-based compensation, where we published something in 2008, which was a year before Basel came out on the compensation front. So just to say, the industry is not stonewalling this. We are taking the issues very seriously. I wouldn't pretend to have solved them, but this is not, we're not in a naysaying mode here. Now, I think it's also important to say, and also contrary to the authors, that in fact there has been a lot of progress. Now, it's not nirvana, and nobody would say we're anywhere near where we've got to be in getting the industry sort of rebuilt. But it's also not as if there's nothing has happened either. We at the IIF do an annual survey of risk management, and every year, for 3 years now, it's shown regular improvement, but also a lot of things that need further work. It's always, you can have your choice, glass half full or glass half empty, but it's not a glass empty in any case. Firms are devoting really huge resources, both financial and intellectual, to cultural change, risk governance, risk appetite, risk IT, investing tremendously in risk IT in particular. The FSB in November published a paper on compensation that said firms were moving in the right direction, that there had been and were being important cultural changes, that benefits were already being seen from those changes. So again, nobody would say it's a done deal. Nobody would say we're all the way there, but progress is there to be seen if you're willing to see it. There's lots of data, obviously, from the BIS and other sources on very substantial capital increases since the crisis. And boards of directors are now much more attentive to risk management, to governance, to the industry practices, to benchmarking their internal practices. The senior supervisors group has been very active and very forceful on focusing on making sure the boards are not backsliding on any of those things, and they certainly intend to continue to do that. Basel itself is turning to supervision, ratcheting up supervision. They just published a paper on data aggregation requirements. It's actually quite challenging for the firms, but it goes in the general direction of needed improvements, and we basically buy it. Costs, including compensation costs, are being reduced. There's a huge amount going on in the firms, and although, again, nobody would say we're already there, a huge amount has been and is being done, and you can't understand what's going on now or figure out what the right solution is unless you take some account of that. Now, of course, there's also a huge amount of regulatory change going on across a very wide front. I should say just a few words about that. It's very far from complete, and it's terribly important to get it right. I guess we agree with the authors on that as well. The basic Basel III program is conceptually fine with us. We have made and continue to make a lot of technical comments, which we would continue to think are necessary. Most of them have not been accepted, I have to say, so maybe I should get my bonus docked a little bit as well. But you know, the basic program is going in the right direction. One of the big issues that we see now is not the Basel program, but the fact that there are multiple solutions to the same problem that are being laid on layer over layer. So you have SIFI surcharges. On top of Basel, you have SIFI surcharges. You have the recovery and resolution process, which is great in many ways, but does generate de facto capital increases. You have local stress testing requirements. You have other forms of gold plating of Basel. You have Pillar 2 assessments. You have now talk about special large exposures limits. All of these things go in the same directions and are largely intended to solve the same problems. There is a danger of dysfunction in layering all these things one on top of the other. Liquidity, you know, contrary to what we heard a few minutes ago, we think that the Basel changes that were made recently in the liquidity coverage ratio were made for purposes of realism. They were extremely conservative compared to what we would have proposed that they change. They still put a lot of pressure for holding public debt. There's an argument of financial repression there. They substantially increase the cost of maturity transformation, which of course is the major function of banks. So you know, we basically give Basel credit for realism, which is the word that Governor King used, but we would say they haven't done nearly enough to make that liquidity regime more workable. On recovery and resolution, we have supported for years bail-in. We've supported and continue to support ending too big to fail. We think the FSB key attributes does a very good job in that. Now I'm getting the high sign on time, so I will try to. Okay, I'll try to go a little bit faster. I should say something about the IIF economic analysis, which the authors kindly put in scare quotes in the book. Phil Suttle, our chief economist, is the one who should really be giving this talk. He's in Moscow now, so you got me. Basically, the IIF analysis was that the impact of the whole regulatory program, that's not just Basel, but the whole shebang, was 3.2% off major market GDP for 5 years. That's more or less 7.5 million jobs in those markets. And I think the important thing to note is that that prediction was made in 2011. Actual experience is much closer to tracking our results than the BIS results. I want to emphasize in saying that we are not opposing the Basel program, we're not opposing the G20 program. What we are saying is we need much more realistic cumulative impact analysis. Now, I will need to skip some other things I was going to say in response to their attacks on our research. I think it is very clear that from a lot of statements the EBA, the ECB, and a number of others have made, that the danger of constraining lending through too great and too fast increase of capital requirements is a very real one. In the long run, Modigliani-Miller has a good deal of validity. In the short run, there's nothing in the book to demonstrate that it's not having a very substantial effect. And the authors say very little about how to get from here to there. We need to hear how you arrive at the capital requirements that you arrive at. There needs to be some methodology. I'm happy to have your judgment, but I'm not sure that's necessarily the most persuasive argument for a really major economic and social change. One of our members estimated that it would cost $2.5 trillion to get the 12 largest U.S. banks to a 25% capital level, which is more or less what the authors have proposed. That sounds like a fiscal cliff to me, and it may be that it's really easy to get there, but we haven't seen any demonstration. I think the authors need to rise to that challenge. There's been a lot of research in England about the effects of equity on lending. Just to note one thing, the Bank of England's FPC policy statement talks about time-variant macroprudential sectoral capital requirements, time-variant leverage ratios, and then, of course, there's the Basel countercyclical buffer as well. All that seems to indicate that they feel they can manipulate on a macroprudential basis the availability of credit through capital requirements. I'm not sure how that fits with the proposals of the editors, of the authors. So let me conclude that there's a lot that could be said about this book. There's some things that are just wrong in it, which we could go into. But a lot of it seems to assume that nothing's changed since 2007. That's not true. There's a lot has changed and is changing. Not there yet, but a lot has changed. They're right to say that ROE is a very flawed measure, but they haven't dealt with how the markets since the crisis have reacted, the problems of uncertainty, the demand that the investors have made for ROE. It may be an unattractive measure, but it's a measure that the whole market uses, not just the banks. Sorry, I'm editing. Sorry, I've lost my place. Sorry, I've lost my place in my notes. But in any case, let me come to my conclusion and say that they have obviously made a great contribution. They've raised consciousness of the Migliotti-Miller theory. They've heightened the resolve of regulators, certainly a good benefit, which we would have to agree with up to a point. But now we need to do a lot more things. We need some solid quantified impact analysis to show the impact if we do take this route, what it would mean to society. How would the equity actually be raised? What would be the cost of doing that? What would be the impact? There needs to be an actual demonstration of that. An ideological assertion of that cannot suffice. Most of the reforms that we're dealing with have merit, but they need to be phased, and the cumulative effects of adding them all up needs to be dealt with. There needs to be a better appreciation of the trade-offs between higher capital and the impact on funding costs and lending. And although the authors assert that there are no such trade-offs, we would certainly disagree with that. As Stefan Walters said, the ideal car is somewhere between a Yugo and a Leopard tank. The ABI had a very good paper on their investment requirements for investing in banks in Britain, and they put as much emphasis on saying that there should not be too much capital as that there needs to be the right amount of capital. To the extent that bank funding is going to be reduced for the long term, especially in Europe, we need to create the conditions for securitization and for other forms of finance. And we've got to get the structural issues right, and deal with the implications of Volcker, Vickers, et cetera. So I think the book, we would certainly say, has made a contribution of putting forward a fundamental proposition. A lot more needs to be done if it's going to be turned into anything like a program for action.
you more time than everybody else.
All right, thank you.
According to you.
Yes, yeah, no, I took that, and I will try to be brief so we can get to the group discussion. Let me thank Anat and Martin for writing such an excellent book. Let me thank Adam for the chance to be here. Let me thank David for being willing to go between the authors and a Bond guy whose opinion might be predictable. But let me also be quick to say how much I agree with in Morris's comments. It'd be hard for me to add much to what Morris said, and I could simply be very brief by associating with what Morris said. But I will add a few other points to try to drive home the point. Even our most junior credit analyst can tell you that the one thing that can lower the overall cost of a bank's capital structure is to increase its equity, because it will bring down both the cost of the equity and the debt. And that's a very simple observation that the most junior kid will know when they go to work. Now, I'll agree, I'm not quite sure what the right number is, 20%, 30%, more than 2% where we were. I do have a simple suggestion about how we'll find the optimal. We'll tell bankers they can only have deferred compensation if it reflects their bank's capital structure. 2% common equity will lead to 2% deferred, 10% common in the capital structure will lead to 10% of their deferred compensation can be in form of the equity. I think we'll find some number between 10 and 30% pretty quickly is the optimal capital structure. So that is, in all seriousness, what I think it would take to help us find the appropriate number. Anat knows that I'm concerned that whatever the number we agree to, enforcing it is the key. And I'm terrified of what I call the three free options that exist in the capital structure of every bank today. There's the free option every derivative trader has to turn any asset into a derivative exposure and move to a preferred position in the capital structure, which I don't think was intended by Congress here in the United States. There's the free option every CEO has to plead for regulatory forbearance to avoid raising common equity when they should otherwise be required to, and therefore undermine the capital structure. And the third issue that I know the Federal Reserve and the Treasury and the FDIC are aware of is the free option of the regulator through systemic resolution to tell us ex ante, ex post, forgive me, which part of the capital structure will get toasted in the event of systemic resolution. And as long as all three of those free options are outstanding, whatever level of common equity we put in, on the table is subject to being undermined and bank capital structures not being stable and taxpayers and depositors not being protected. Let me say briefly a couple of things I admire, or indeed I'm jealous of in the book. I'm terribly jealous of the story of Kate and her mortgage. For those of you who haven't read it yet, we get to work through the T accounts, the double entry bookkeeping of what it means to take on leverage. I've always used that as an adage to young analysts about go do the T accounts, go figure it out how a bank works, and they have worked their way through it. I'm also jealous, but there's still a little room for me yet, with a metaphor about bankers as truck drivers, thinking about the Basel Capital Accord. I have often told the story of the country where they tried to adopt risk-based airbag pricing to improve highway safety. I won't go through that now. Let me, though, mention a challenge that I think is with us, and I'm not thinking Anat and Martin are going to disagree with me, but I think it's more than they've alluded to here and more than the book alludes to, is the challenge of getting more equity into a banking system that must shrink. That's actually a very hard issue. That's not a question of good guys and bad guys or easy stories or bad incentives. And so the fact that we are overbanked in Europe and overbanked in North America, that's a problem. Now, getting more equity in itself, I share the view that that's an important answer and that we should have more equity and it would make the banking system safer if we did. The fact that simultaneously with that, We need to shrink the banking system because there are not enough earnings to go around, even for the banks that may become well capitalized in the due course of right-thinking policies. That's a dilemma. That may well retard growth from what we're used to, because we're all thinking we're going to get back to the mean of the great moderation, of ever-rising levels of indebtedness. And I don't think we are. I don't think that's a reasonable place for us to go. So it doesn't surprise me that there are lots of measures of deadweight loss to society from adopting disciplined approaches to bank supervision if the assumption that we're measuring ourselves against is a reversion to that trend mean of the great moderation of ever-rising levels of household indebtedness that I don't think is either possible or desirable. But I know that Anat and Martin don't really disagree with the point I'm making, but I think that brings out the really difficult political issues we have that are not amenable simply to the application of smart thinking and political will. That in Europe, as Martin alluded to, the problem of national champions, the illusion that we could create a common euro area, a common currency, but have disparate banking systems. Here in the United States, we have something more curious. We have the legacy of Andrew Jackson giving us a world in which everyone who graduates from college is thought to be entitled to charter a bank or at least a securities brokerage firm. And that really doesn't work either. We can't have open creation of financial intermediaries and disciplined management of the quantum once we have them out there. Let me stop there. Thank the Institute and the authors for the opportunity to be here, and now we're on to the stage, I think. Thank you.